Welcome back to the channel today. Let's explore a powerful yet conservative option strategy known as the covered call, particularly focusing on how to implement it using the SPY ETF. This approach is designed to generate additional income from your established stock positions, allowing you to leverage your investments without taking excessive risks. So, what exactly is a covered call? At its core, it's an option strategy where you hold shares of a stock or ETF, like SPY, and sell call options against those shares. This method entails collecting a premium from selling the call option, thus creating an additional income stream while still owning the stock. It's especially effective in steady markets that are sideways or experiencing slight bullish trends, making it an appealing strategy for many investors. Now let's discuss why SPY stands out as a prime candidate for this strategy. SPY is an ETF that tracks the SP 500 index, celebrated for its liquidity. The advantages of trading SPY include tight spreads, high trading volumes, and a variety of options to select from. Furthermore, SPY's steady and predictable movements make it an attractive choice for executing covered calls, offering confidence in your trades. To use this strategy, the first thing you need is to own at least 100 shares of SPY. Once you have secured those shares, you can proceed to sell a call option against them. For instance, if SPY is currently trading at $430, you might opt to sell a call option with a strike price set at $440, with an expiration date just 2 weeks away. By doing so, you'll collect a premium for the call option sold. If SPY remains below that $440 strike price upon expiration, you not only retain the premium but also keep your shares. In the event that SPY does surge above $440, there's a possibility your shares could be called away. This means you would need to sell them at the $440 strike price, while still pocketing the premium you collected earlier. With this strategy, you can maximize income while retaining a significant portion of control over your stock assets. In summary, using covered calls with the SPY ETF offers an effective way to enhance your portfolio's earning potential. Imagine you hold a golden ticket, 100 shares of SPY currently valued at $430. You decide to sell a call option with a strike price of $440 that expires in 2 weeks. This decision grants you a premium of $250 per share, totaling $250 in your pocket. Picture this. If SPY remains below $440 by expiration, you relish the thrill of keeping both your cherished shares and the premium. However, should SPY soar above $440, your shares are called away, yet the premium remains yours. The scenario is visually rewarding, isn't it? Now, let's deepen our understanding of this strategy. Selling calls during periods of low volatility can be your friend. The premiums become more favorable, painting a brighter picture for your income potential. Think of it as fine-tuning your strategy. The calmer the market, the more you seem to gain. As expiration approaches, be vigilant, monitoring the market movements closely. Timing is crucial to maximizing your returns. A keen eye can mean the difference between a lucrative payoff and missed opportunities. It's essential to recognize that this approach tends to thrive in slightly bullish or neutral market conditions. If your outlook leans towards a grand market rally, tread carefully. The last thing you want is to lose your shares in an ill-timed hustle. Grasping these nuances opens up a world of income generation from your existing portfolio. As you absorb these insights, think about your own experiences with covered calls. Have you tested the waters before? Or is it a new venture for you? Visualize the empowerment that comes from crafting a strategy tailored to your financial goals. By adopting this perspective, you are setting the stage for informed decision-making. In closing, mastering the covered call strategy with SPY is akin to painting with your financial brush. You decide the hues and tones, creating a masterpiece that enhances your portfolio. Strike the right balance between risk and reward, and navigate through market waves like a seasoned captain. If this insight has illuminated your path, consider giving it a thumbs up and subscribing for more content in the world of options trading. Each step you take is a stride toward financial literacy and empowerment. Let's embark on this journey together, exploring the myriad of opportunities that await. Thank you for watching, and stay tuned for our next adventure in the world of trading. Navigating the world of options trading requires a deep understanding of key concepts, particularly strike prices and expiration dates. The strike price, the predetermined price at which you agree to sell your shares, is crucial in shaping your strategy. When selecting a strike price for your SPY shares, consider your market outlook. If you anticipate minimal movement, a strike price close to the current SPY price allows you to capture a higher premium, giving you instant gratification. Conversely, if you foresee a significant upward trend for SPY, opting for a higher strike price can be beneficial. This approach not only protects your potential gains, but positions you advantageously for future profits. Imagine the excitement of watching SPY rise, leaving room for price appreciation. However, this choice requires balance. You want a strike price reflective of your comfort level with selling, while embracing the optimism of market conditions. Expiration dates play a pivotal role in this equation too. The longer the time until expiration, the more premium you can accumulate. However, this extended timeline carries the risk of SPY surpassing your strike price. Picture yourself watching SPY soar beyond expectations, only to know you'll be locking in a lower profit. This dual-edged sword demands careful consideration. Weigh your desire for additional income against the volatility of price movements. Selling covered calls on SPY presents a remarkable opportunity to generate extra income. You are effectively compensated for agreeing to sell your shares at a higher price, which is particularly advantageous in sideways or slightly bullish markets. As the market stabilizes, collecting premiums while retaining ownership of your shares is like mining gold from your investment portfolio. Yet every strategy bears its share of risks. The most notable downside to covered calls is the caps on potential upside. If SPY experiences an unexpected surge, your gains are limited to the strike price, leaving you to witness the rally from the sidelines. Alongside this comes the risk of assignment. Should SPY breach your strike price prior to expiration, your shares could be called away unexpectedly, potentially disrupting your investment strategy. Balancing the allure of income against these inherent risks requires a strategy as dynamic as the market itself.